So I started these webinars, earlier this week because I had been thinking that, most of us are getting PPP dollars and eventually CERTS funding. And what can we really do with that money to, give us the best return on investment? And so I put together 10 ideas that have 10x ROI. And they're ways that are mostly focused on spending those payroll dollars to improve the business. And so I think everyone is probably pretty familiar with PPP and CERTS. The government calls them forgivable loans. I like to think of them as free money. PPP dollars, you need to apply by March 31st. And that's right around the corner. So if you haven't put in your application, do that soon. If you didn't get PPP1, you didn't apply for it, you are still eligible. CERTS is a little more complicated than PPP. It is $2 billion for the motorcoach, school bus, and passenger vessel industries, but details are TBD. I personally am expecting applications to potentially be available in 6 to 8 weeks, with funding maybe in May. There's a lot of question marks around that. And I know the associations are working with Treasury and trying to move that along, but they do have to stand up a lot of processes. I'm talking about financials today, but it is important to know I am not an accountant. I do not play one on TV. If you don't have a great accountant, Tracy Fickett is my go-to in the industry, and you can reach her at busbooks.co. PPP and CERTS funding both require that you spend 60% of those dollars on payroll for forgiveness. And it's important that we make the most of it. I know for a lot of people who are operational, you can use those dollars to pay your staff that are running, charters and line runs and work and manager salaries. But if you don't have that enough work operational, then you have to spend it on other types of payroll to get forgiveness. And so this presentation is really about, things that you should be spending your time or directing your employees to spend their time doing. It's my opinion that we won't return to what we thought was normal. And truthfully, we can't really, at least for the next few years is my opinion, because the world has changed and we're doing things differently. And there's going to be this growth period where we, get back to doing all the things that, we know and love to do, especially travel. But we have to return to better. And this, catastrophic last year does provide us with some opportunities to rethink our business and to figure out, how we're going to move forward productively and profitably. The reason that I'm having this presentation is because I feel like I can help. Our team has more than 40 years of combined operating experience. I was an operator for 10 years as an employee. Then I went to business school and consulted with them for the last 5 years. If you've ever had a really badass VP of operations, then you know exactly who my partner, Ryan Johnson, is. But we are operators turned technology nerds. And along the way, we learned a lot of other really random knowledge. And you will find out today that I am not only a technology nerd, I'm a financial spreadsheet nerd, which I know some of you know already. But we have experience running businesses and thinking outside the box about the best way to solve problems. And so from finance to strategy and operations to marketing, we feel like we can help. And I decided to put on this series of 7 webinars to offer that education to anyone who wanted to hear it. So we are members of a number of great organizations. I'd love to expand that list when budgets come back. But until then, this is what we're doing. So I really feel like to get the best ROI, we need to be spending smarter, and that means working smarter. I blacked out this guy's face because I was so embarrassed for him. He is carrying a wheelbarrow of bricks. It just seems like not a great way to get a project done for sure. So I'm talking about smart strategic finance, smart marketing, organization, cost-effective technology, which is where the L&W team has really built a business, and then leadership. And those are 5 places that I think we need to be focused as an industry as we move forward. But today, let's talk money. So I named this presentation Dollars and Cents, which, as my business partner Ryan knows, I've been wanting to use for the last 5 years. So thank you for finally allowing me a place to use it. My role, so I managed a $10 million P&L for more than 10 years as an employee, and then 5 years as a consultant. And I always wanted to know whether the expense equaled the value. Frankly, I didn't care how much money we were spending on something if it was valuable and made sense. And I looked at every line item on our P&L just like that. And so to me, it wasn't about, which buckets it is in, but it was about, what am I getting in return for those dollars? And so today I'll talk through some of that mindset. Projections and budgets and value. Oh my, I feel like Lion, the Witch, and the Wardrobe here. But I remember when I started doing my first set of projections and budgets, I remember being like, what does next year look like? I have no idea. And this was pre-pandemic, and the world was a much easier place to understand. And I remember my CEO at the time said, that's totally okay. Projections are crystal ball stuff. And it made me feel a lot better that projections and budgets are really just guessing. And it's best to make reasonable assumptions, and then you can run some different models with different assumptions. And a great example of that is when you think about capacity on the buses. Many of you are making choices about how many people you load on a bus, and that can vary if, it's a charter and everyone knows each other and they're comfortable with each other versus if you're selling, individual tickets for a trip to the general public. There may be some requirements that, the state or the city has put in place for you to limit capacity issues. We see this at restaurants and gyms. And you could say, okay, well, if my capacity on board is 25%, then, I can sell X number of tickets. But if my capacity jumps to 50%, then I can sell, Y number of tickets. And obviously the number of tickets that you put on each bus will indicate, how much money you can make. And so if there are, pieces of the business that you just don't know what those limits will be, you should be able to build into your financial spreadsheet a little box that has a capacity number of 25% or 50. And then you can, type in 25, or type in 40, or type in 50, and your whole model will change. I hope that's the nerdiest I get with spreadsheets, but I'm pretty sure it's not going to be. So if you do have questions about that, I'm happy to show you how to do that on a spreadsheet offline. But it is important to just recognize that no one knows what the next 12 or 24 months looks like, and that's okay. Make reasonable assumptions and see what the bottom line and what those numbers mean. Budgets. I loved to tell my team that there was no budget for whatever they wanted to do. And they would come back to me and they'd be like, Trisha, we have to spend some money doing that. And I was like, yeah, that's fine. I'm happy for you spending whatever you need to spend on this. And I remember specifically a story about a vacuum. We needed a new vacuum in the office. And I was mad because we had just bought a vacuum like 6 months before, and vacuums are reasonably expensive when you get a decent one. And they were like, okay, well, how much money do I have to spend? And I was like, you have no money. They were like, I have to get a vacuum. I was like, yeah, get a good vacuum that you think is a good value. When you push your team to not fit inside a price value, inside a price box, you actually get them to focus on value. And so the vacuum that we ended up moving forward with was, I think, a $400 vacuum. It was more money than this person had thought about spending. They were like, $100 budget, is that fine? I know we just bought one. I was like, no, we need to get a valuable vacuum, one that's going to last us for the next few years. Now that's a sort of silly example. I know that, most of us are not thinking about these, $400 vacuums, but, as you look for software or, rent or other things that you are investing in, you can, if you set a budget of $10,000, the price point of the products you're looking at are probably somewhere between 8 and 12. But there's very likely solutions that are $2,000, $3,000, or $4,000. And if you tell your team they are looking to find the right solution for the problem, they will start not with budget and price, but with value. And if you're starting with value and you run this across the entire business, what you'll find is that at the end of the day, you're getting a lot more for your money. I also want to tell a story about Mickey Mouse. So everyone's familiar with Disney. I know the people out in California, Disney being closed has been largely very impactful to businesses out there. But when you think about Mickey Mouse versus street sweepers, who do you think gets paid higher above average rates? So Disney has, very high expectations for their employees. And so my guess is that generally they're paying above average in the area for both Mickey Mouse characters and street sweepers. But who is more important having a great Mickey Mouse or a great street sweeper? You've reached the engagement portion of the webinar. Unmute, take a guess.
I'm going with street sweepers.
Why?
Because if it's a mess all over the place, people are going to see that before they see Mickey Mouse.
That is true. So you are correct, Allison. Street sweepers is right, but I'm not sure it was for the exact reason. So you assume that a good street sweeper is going to clean up that mess and keep it clean. But what Disney values about street sweepers is that they're also engaging with patrons. They're also seeing a baby crying and asking if they can bring them a bottle of water. They're pointing out directions to the bathroom. The average street sweeper is going to keep things clean, but they're not going to provide that high level of customer service that they necessarily want. So while the average street sweeper in California might make $15 an hour, Disney is very happy to pay $20 an hour and get the amazing street sweepers that make the Disney experience not just clean, but also enjoyable and friendly for their guests, because they have street sweepers all over the park that are engaging with their patrons way more frequently. Mickey Mouse, the people who are Mickey Mouse, there's not a huge range of qualities about those employees. They're inside a costume. Yes, they need to be friendly, but anyone who is playing a character is probably friendly and good with kids anyway. And so they can actually pay average market rates for Mickey Mouse, but they want those great, amazing street sweepers to really make the experience. And so when we think about our business and what we're paying our employees, what is the most important thing about your business, and where should you be paying potentially above market rates or more than your competitors to get those pieces? Walmart is an interesting example. Their business is profitable not only because they're everywhere selling a lot of things, but they have razor thin margins. And so a penny here or a penny there on whatever you're selling in Walmart really matters. So they invest heavily in paying above market rates to their finance people and contract negotiators, because they have figured out that piece of their business is what's most important. And so when you think about what your value is, you can think about what is really critical. It may be drivers, it may be mechanics, it may be your sales team, but what is really the most important thing? And it may not be any of your employees. It could be new buses or shiny buses. But when you think about what is your value and how do you really make that value 100 times better than your competitors, that can make a difference. And that's a place that you want to invest. Financial statements. I think the most important thing to remember about financial statements is I always ask myself, does it make sense? Does what I'm looking at seem to pass the smell test? So, for some of you who, feel like whenever you're looking at financial statements and spreadsheets, it just makes no sense and I get very confused, that's totally fine. Ask yourself, does this make sense? And you can do that for year-over-year comparisons. You can do that for month-over-month, or how much are you spending in one category versus another. It's really important to step back and realize that they're just numbers, they're just financial statements. But if you think about, does this really even make sense? Oftentimes you'll find that it's very easy to spot problems if you ask yourself that question. So there are 3 financial statements that should be produced in any business. Balance sheet is up here. Does anyone know the other 2? The other 2 are the income statement and a balance sheet shows your assets and your liabilities. It's a snapshot, and so it's a fixed moment in time. So if I had 10 apples yesterday, my balance sheet yesterday would show 10 apples. If I sell an apple, then my balance sheet will only show 9 apples today. So it isn't over a period of time. Assets are things like cash. They're also things like buildings and buses, and what people owe you. So that's an asset. People owe you that money. Liabilities include debt, what you owe people, obviously, and then unearned revenue that's in your bank account. And so that's not money that you have yet. It also has equity. So assets equal liabilities plus equity. Your income statement is your revenue and your expenses, and that's over a period of time. And so you can't say at this second that you have revenue, because in that second you didn't make anything and you didn't have any expenses. And so you look at an income statement over a period of time. And revenue should reasonably tie to expenses. So I was just talking to a client the other day, and they have a school bus contract that pays them twice a year. And so they get money in January and money in July, or whatever it is. And that means that in February, they technically have no revenue from the school bus contract, but they have all these expenses. And so you should really split that revenue up into different months so that your revenue reasonably ties to your expenses. This will help you when you are looking at your financial statements. It'll also help you understand, what the value of those expenses versus revenue is. Now, for a lot of businesses, they work on what's called cash accounting. And so they don't need to take those things like school bus contracts and break them up by month, because generally they get paid and then they perform services. And so their revenue happens at roughly the same time as their expenses. But if you do have some of these large payments that are coming in over a period of time, you may want to move to what's called accrual accounting. And accrual accounting is definitely more complicated, but it means that if you got a large payment for a school bus contract, you would split that out and it would live on your balance sheet until the month happened, and then it would move over to the income statement as revenue. Not all payments are expenses, which is a bummer, but not all expenses are payments as well. So sometimes you make payments like, for instance, principal payments on your buses. You pay that to the bank, it's cash coming out of your account. But in that payment is interest and principal. And the principal is not an expense on your income statement. That actually, it does go into your cash flow, but it writes down your debt on your balance sheet. So when you're thinking about your net profits, that's not equivalent to your cash out the door. On the other hand, not all expenses are payments. This is great. We see things like depreciation. When you write down the expense of your buses or of a location, those do come off of your expenses, and you can write them off on your taxes, but you're not actually paying anything out the door for depreciation. The third statement is the cash flow statement. And so this is money in and money out. Again, it's over a period of time, because in a split second, you can't spend any money. but over a period of time, you obviously do. And a cash flow statement is divided up into operations, investing, and finance. I have a quick example here. When you think about cash flow from operations, that's your net income off of your income statement. And then depreciation and accounts payable will get added back in there. And then if you have any increase in accounts receivable or increase in inventory, that gets taken out. At this point, I want to let you know that this statement always confuses me. I never can understand and wrap my head around the fact that how is an increase in accounts receivable less cash? So I want you to know that that's totally fine, that it confuses you because it also confuses me. The piece about that you need to ask yourself is, does it make sense? And sometimes you have to think through these significantly. Once you set up your spreadsheet to actually do the right math, then it works out great. You never have to think about it again. So you only have to be confused for a day or two. Cash flow from operations is all of the income and expenses that are coming in and out of your regular business. You also have cash flow from investing, which is often purchasing of equipment or those big capital purchases, things that usually tie to your balance sheet. And then cash flow from financing. These are your loan payments or interest or things like that. So all three of these pieces are what brings you to your cash flow for the month or the year. Now, I know when you dig into accounting things, there's all these words like debits and credits. I have a lot of financial education, and I still also do not understand debits and credits. So when I put them into QuickBooks, I look at them, I ask myself, does it make sense? If it doesn't, then I reverse it and make sure that the money is moving in the right direction. You do not have to be a super genius or an accountant for these things to make sense or not make sense. So know that even those of us who've been doing this a long time get confused, and it's totally okay to ask questions and be confused. If you are not looking at these three statements for your business on at least a monthly basis, if you're an owner or in leadership, you really should be. They give you a lot of interesting information and help you understand where your business is going. Strategy around business is really important. At the end of the day, it matters that we're profitable and that we have enough money to stay in business. So I highly encourage you to pull your head out of the sand if you're ignoring these and start looking at them. The next thing I'm going to go into is metrics that matter. And I'm going to go through a couple of important vocabulary pieces before I get started. On your screen, you see I'm calling it an average bus company. I set the revenue of $1 million to make my math super easy. If you have a larger business, you can obviously multiply that by a factor to get your revenue there. But hopefully the percentages and the dollar amounts align with sort of a typical bus company. Variable costs are costs that vary, shocking on that word, that vary based on how much business you're running. So when you don't have any buses running, you're not spending any money on fuel, so that's a variable cost. Maintenance, I think there's sort of a baseline of maintenance that we should all be doing so that our buses are maintained, even if we're not running. But obviously, as you start running more, those costs go up. Fixed costs would be things like insurance. Typically, we have an annual insurance premium that we have to pay each year, no matter how many buses we're running, and that doesn't change. And so that that's a fixed cost. You can think often of your manager's salaries also as fixed costs. Now, I want to point out that payroll can be both variable or fixed cost, but there's also a trade-off in payroll from investing in technology. That's one way. You can also invest in outsourcing to trade those payroll dollars for other expenses. And I'm not trying to get rid of everyone's jobs, but if you bring in employees who need to be full-time employees, you may be able to outsource that to a part-time person or to project work. There's lots of people who are working remote right now, as well as many consultants and vendors in the industry that you may be thinking about looking to. So, payroll doesn't just have to be those full-time employees. We talked a little bit about the cash flow statement, and from a cash flow statement is where you get your cash burn. And that's the total monthly amount of cash out the door. I want to note on this spreadsheet, your cash burn is not equal to, here it would be profit of $45,000, but that is not your annual cash burn. The things that you have to pay from this would be your cash from operations. Well, it's not even your cash from operations, but you want to take your cash from operations and add your cash from financing and your cash from investing to get your total monthly cash burn. Right now, this number is very critical because most of us are hemorrhaging cash, and we need to know how much longer we have to be able to stay in business. And so if you figure out what your total monthly cash out the door is, and then you take the amount of cash in bank and divide it by your cash burn, you'll get your runway. And so I hope that most of you have at least 6 months of runway. If not, you should be having some, internal conversations with your team and understanding what you're going to do to change that. But that's a really important metric to be thinking about right now, because if we don't have any money, we can't be in business, and that's not where we want to be. I put this other P&L together to show you where you could be so that we can talk about some of the differences. The biggest difference that you'll see is investments in technology, marketing, and advocacy. I think that the work that was done on CERTs, specifically with, my group in the Gang of 11, as well as a lot of other people at the association level and across the country, was amazing. We got $2 billion, which will really help our industry. But we need more, and we should be investing in advocacy work to help us get additional funding, not only from stimulus, but other programs like security grants. We're talking about the fact that group buses are one of the last forms of group transportation that's still paying a fuel tax. Vicki, I know you're having a lot of conversations in California about those DMV fees, and we really should be investing in advocacy to have the government help our businesses in a number of different ways. The other places that we can be looking at spending more money than we're spending now is in technology and in marketing. And so marketing, if you build it, they will come is not something in the bus industry that we have anymore. We need to be putting our names out there to make sure that our customers know who we are and that they can hire a bus. And that those marketing dollars are not cheap, but as you see, they can result in additional revenue. So here I spent $55,000 on marketing and I brought our revenue up to 1.1. Those are dollars that you can work really hard for, but as you can see, they pay back, immensely. And especially as there's a lot of competition over the next 12 months into who gets the limited amount of work that happens, the more money that you can be spend marketing, in my mind, the better off your company will be. I just heard a story about a guy who is running Google ads in a new region of his state, and he booked a 2-week trip to New Mexico, from a Google ad that cost him less than $5. That's, a great story and an awesome return. And when you do those over and over again, you'll be having more success. The other place is technology. And I totally realize this is completely self-serving because this is the kind of technology that we build. But we believe in it because when you invest in technology, you can see your payroll costs go down. And that's really critical as you're thinking about growing your team back. Everyone is working on a skeleton crew right now. And I know a number of people, when we start running, are going to get their bandwidth eaten up significantly. How can you invest in technology that actually lowers your payroll and gives your team more opportunity to do more? Because there's a number of things that I know each of you are doing that you don't need to be doing. Robots can be doing them. And so that you can focus on the things that matter. The other place that technology is going to come in really useful over the next 12 months is before you decide to hire a full-time employee, what Rarely do you hire a full-time employee when you actually need 100% of their capacity, right? You get to the point where you're like, oh man, I need half a person and I can't hire them part-time, and in the next 6 months, I'm going to need them full-time, so we'll hire them full-time now. Okay, well, you don't necessarily need the full-time person right now, so can you invest in technology to lighten that load and push that down the road? I believe that employees are a hugely valuable part to our business, and I want them to be working hard for us, but I want them to be doing things that only they can be doing. I want them to be managing employees. I want them to be having conversations with other employees, strategic ideas, project work. I don't want them to be pushing papers, filing, doing data entry. And you can see that here I've made an investment of almost $22,000, and I've actually brought down our operating payroll from $350 to $330. And when I think about other payroll, I've brought that down as well by $12,000. Now, these are generalizations that would happen, over the course of a year as you merge your business. But you can see that even though I've added almost $100,000 of expenses, I've actually increased our profit by almost $50,000, more than $50,000. And that's an incredible amount when you think about taking profit from 4.5% to 8.9%. So there are ways that you can change things in your business to make it more profitable if you think outside the box and really dig into your numbers. And it's, like I said at the beginning, it's not about how much money you're actually spending in terms of $5,000 here or $100,000 here. It's about what value are you getting. And I would much rather see you spend an additional $5,000 on advocacy and $50,000 on marketing than something else that's not going to give you that same return. The next piece that I want to get into is pricing. And so I believe that you should be charging your clients what actually costs to run a bus. And I think it's really often difficult to figure out what it actually costs you to run a bus. And so I've put this together so it's a short example. I assumed that utilization for this company is 60%. There are 365 days in a regular year, and this $1 million company has 5 buses. If you multiply all these numbers together, you get bus days. And so that's how many days a bus is on the road. I took the numbers from our previous spreadsheet and I put them in here, and I adjusted a couple of them. One is net cash flow. I decided that I wanted to base the pricing based on making $55,000 a year. Some financial guru 10 years ago told me that you need to pay yourself first. And since then, I've been trying to do that. And so if you don't incorporate this into your pricing, at the end of the year, there's possibly nothing left. Also, loan payments. Loan payments are part of your cash out the door, even though they're not part of your expenses. And so they need to be factored in here. If you don't have any loan payments and you have older buses, that means your pricing will be less than if you have new buses, and your customers should be paying for that. The other thing is that I adjusted our driver payroll. So I decided that, in the place that we're at, I wanted to be paying our drivers $25 an hour plus taxes and benefits. And I assumed it was a 10-hour day. And so the cost of my driver is $300. The other pieces I've taken, mostly from the expenses. You can see insurance was $120. We had interest payments, and I added up some categories of overhead. When I take those numbers, that 55,000, and I divide it by 1,095 bus days, what I learn is that every day that a bus goes out, I need to be charging $50.23 for that portion of the bus for that day. And when you go through and you add up all of these pieces, this means that you get to a daily rate of almost $1,200. Now that's a lot of math. Does everyone understand how I got there, or do you want me to go? Does anyone want me to go a little bit more deeper into how that math works? Okay, if you have questions about it later, ask me. I'm happy to go through it, but I want to get to the strategy part of this. What's interesting is that if I assume that in a day a bus goes 300 miles, that means my average per mile rate should be $4. The real kicker that drives me bananas about this, though, is that if I take the daily rate, so the amount that I should be charging, and I multiply it by the number of bus days, the revenue that I get is almost $1.3 million. So that means if these are my company metrics, this 60% utilization with 5 buses, and these are my expenses, if I'm charging the correct pricing, I should be making almost $1.3 million. But you remember, I'm not. I'm only making $1 million. Well, that's not right. Like what? And the difference is that a company with these expenses, I guess I should say these expenses, that's making $1 million is upside down in their business by $300,000. They're not charging the right pricing for what their expenses are. And I worry that a lot of bus companies have this issue. They have pricing that doesn't get them to the right amount of revenue. What you would want is if you did this math and it worked out, your revenue should be close to what you expect to get. Now remember, they are projections, they are budget, this is all crystal ball stuff, but you want it to make sense. And that's one thing that does not make sense about this. And so we either need to adjust our expenses or we need to increase our pricing to match what our revenue makes. Does that make sense? Okay, I'm going to guess that everyone was just boggled. Oh, thanks, Larry. I was going to guess that everyone was just boggled by my spreadsheets and move forward.
It's called basic math. You did it very well, Trisha.
And so, it's interesting when you look at your business and if you figure this out, if 1.3 is not equal to 1 million, you have some adjustments to make. You need to charge your clients what it actually costs you to run a bus. And I think it goes without saying that if you're, not going 300 miles a day or these metrics are different, adjust them for your business. If you have half day rates, you can adjust that. But, at its core, this is a very simple way to figure out if your pricing is in line with how your business should run. The thing that I love about this is that we can increase our profitability and our revenue without buying more buses. So currently the metrics that I had were 60%. And, these metrics are the same as they were before. So almost $1,200 daily rate for a revenue of 1.3. That's a growth over your current metrics of over your current revenue of $1 million of 28%. But over the next few years, we might not be able to buy any buses. And so how do we increase our revenue? Well, you do it by increasing your utilization. Whoops, went backwards. Increasing your utilization. If you move your utilization from 60% to 65%, your bus days increase. You don't have to increase your pricing, but your revenue goes from 1.3 to almost 1.4. That's a growth of 8.3% per year. That's amazing, right? You haven't had to increase, you don't have any more capital costs. Your fixed costs will all be shared with that same that same number of buses, with those same number of salaried employees potentially. Your variable costs will increase, but those fixed costs may stay the same. And you can see how this makes a huge difference if you move from 60% utilization to 75% utilization. If you did this over a 4-year period, you would get 8, 7, and 7% growth year over year. If you did this in a 1-year period, you could get a 60% growth over where you are at now. That's probably a little unreasonable to think about going in that direction, but big leaps and bounds can be made. And I would argue that utilization is increased mainly through marketing and getting the word out about types of work that you can do and hustling to get your customers in the door. I'd mentioned technology, and I'm going to talk a little bit more about how technology can offset some of those payroll costs. Probably, I think most of you have been on my webinars before, and so you've seen this math. When 10 hourly employees spend 15 minutes per shift at $30 an hour, it costs almost $20,000 per year. I know many of you probably are looking at that $30 an hour and being like, I don't pay anyone $30 an hour. Well, with taxes and benefits, it probably gets close to that for many of your mechanics and probably your drivers. And for many of you, that'll be higher than that, depending on the city that you're in. When managers are spending 3.5 hours per week on paperwork, it costs a month of productivity. And I made this point to a friend the other day. I said, if you're spending 10% of your time pushing paper around, that means that you are spending from Thanksgiving until New Year's entirely on paperwork. You know how they made that? It always makes me really sad. Apparently, every dollar I earn, I'm paying taxes until April 1st or something ridiculous. When I think about everything that I get done between Thanksgiving and New Year's, that is a ton of time. And that's only 10%. So technology can offset that to make it really worth your while. And I want to show you how. So think about this. So B, philosophically, of course, unless you have a CDL, and I know some of you that are leaders and owners with CDLs are driving right now, but philosophically, be a driver for a day. Walk through what a day in the life of a driver looks like and count the number of annoying or time-consuming processes that they go through. Then count the number of 2019 drivers that you had. You can make this a full-time equivalent and your number will be lower, or you could just use the number of drivers that you have. And then figure out what those processes cost. So the cost is going to equal your 2019 drivers divided by 10 times the number of processes times 18,750. As an example, which I made for you, if you have 5 processes, let's say they have to, check in through signing off on some paper, they, punch in on a time card, and maybe they have to walk to the office to put in a scheduling request. You're probably cleaning your buses and they have to fill out a form for that. Maybe when they check in, you ask them if they have been in contact with anyone who's had COVID or if they have any COVID symptoms. Maybe you take their temperature, and they probably have some inspection paperwork that they're doing. Those are an example of 5 fairly simple processes that you may not think take very long, but probably over the course of a shift, it takes about 15 minutes. Let's say you have 30 full-time equivalent drivers. And so the math on that, 30 divided by 10 times 5 times 18,750. Can anyone ballpark where this number gets to? No calculators. I know we're all sitting in front of a computer watching this Zoom screen. Take a guess. No one wants to guess. Okay, I'll show you. $281,250. That is a boatload of money that you're spending on check-in, time cards, cleaning, employee health screening, and inspection paperwork, potentially. I don't know what annoying and time-consuming processes that you have in your business, but I guarantee you when I look at almost $300,000 and think about the expense equaling the value, it's a hard no from this side of the table. So those are things that you can think about when you're thinking about what you can do to increase your efficiency in your operation and what dollars you're actually spending. I think this slide was supposed to be earlier, so I'm going to skip through it. I was talking about adding on employees and how you grow over the next year. And this is an example of, as you're growing back, let's say, it's March next month, and you're going to hire 2 part-time employees for $2,500 each. And you go through and they work for you in March and in April and in May, and then in June, they've worked for you 90 days. So you need to give them some additional benefits. July and August comes around and you realize you need more staff. And so you hire someone else part-time. And, after they've worked for you for 90 days in November, you owe them benefits. Well, now it's December and, I added in some Christmas or holiday bonus. And I know that some companies don't necessarily pay holiday bonuses or Christmas bonuses, or end of the year, whatever. But over the course of a year, I guarantee you spend $500 at least per employee on all kinds of random stuff. Here, let's buy lunch for the office, or, we need new supplies for that employee, or whatever that looks like. January comes along and unfortunately we had to let someone go. We don't have that person in. but in March, they've been there a year, and so we need to give them a raise. So the total expense for that story, $91,000. With technology, if you look at what you're doing with your employees and you say, okay, I'm going to hire one person, but I'm going to invest in technology to alleviate the burden for this other employee. And I do that for, 5 months. The exact same story is true. But then again, in August, when I look at hiring another employee, I think, you know what? Nope, I'm going to invest in more technology. Now, if we could make that happen over the course of the year, instead of spending $91,000, we would spend $49,000. And I think everyone on this call would agree that that's the kind of math that we like to see in our business. It's a difference of $44,000. Unfortunately, I think most people say, well, then I'm spending $10,000 on technology. That's a lot of money. And it is, but you're already spending that in payroll. And so we have this opportunity now where we all are working on skeleton crews. And as we're growing back, we can grow back by investing in technology and making sure that we're getting the best work from our leaders that's possible. Because it's okay to spend $10,000 on technology if we're saving $44,000 overall. And prior to the pandemic, this always had the feel of like, well, what's Julie going to do? Like when I outsource her job from technology. And rarely does that, does it happen that you can fully automate one person's job, although I have seen it happen. But, we're at a point now where as we're growing back, we need to grow back smarter. And this is one way to do it. I believe that for every $1 million of revenue, you should be spending $25,000 on technology. And it's my belief that that is not an increase in expenses because you're currently spending at least $100,000 to do the exact same thing. So as you're looking at your financials and thinking about the ways that your expenses are providing value, think about what you can do with technology to shift some of those payroll costs into other categories that you haven't necessarily thought of before, because you're really looking for value. And it'll be really, really critical as we have, high fixed expenses and not a lot of variable expenses over the next 12 months. As our revenue grows back, we need to make sure that we're really controlling what those expenses are so that we can be profitable. I had to put Tom Cruise in here because it's my other favorite finance meme. I'm here to help. I hope this was helpful today. I'm happy to chat. If you feel like all of this was really talking to you and you're like, I don't even know where to start, we are offering a crash course in dollars and cents so that over the next 8 weeks, we can take a look at your company and talk you through, what this looks like and what potential areas you have for improvement. It would include an initial review plus 4 biweekly meetings. For me, it's about real talk. It's about some of those tough love conversations around strategy, but also education. How do you think about things and what are you thinking about? And frankly, what do these numbers mean? Or I don't understand these words. I learned a lot of my financial education by being curious and just asking people who, knew what they were doing a lot of crazy questions. I think I was one of those real pain in the butt clients for a long, long time, but I have learned a lot and I'm happy to share that. So if that's something that's of interest to you, let me know. We're also, I end all of my webinars with a reminder about leadership. Who's in charge here? Captain Obvious reminds you that it's probably you. If you're spending your time on these webinars, you really care. And so whether you're a bus company owner or you're in a leadership role, it's your role right now to dream and decide and to make some changes. I think the 2 biggest things that you can do as a leader right now are really to ask for help from your industry friends, from your employees, from your family, to get the resources that you need to get out of this mess, and then to be the change. This is Socrates. A friend of mine and I have Socrates dinners, or we used to. And thinking about what do we really want and how do we really make that happen is really important right now, because we have this opportunity where we have some bandwidth in our time and in our calendars to be making changes, but changes don't happen automatically and they don't happen overnight. So decide that you want to make changes and then just figure out how to do it. And if you need some help, we are definitely here. And most of you probably already have my cell phone and email, but if you don't, please feel free to reach out. We have to return to better. The way things were working, it's not going to be a pretty picture over the next 12 to 18 months if we continue to do things the way that we always have. And so I highly encourage you to push for change within your organizations. And a friendly reminder, it's okay to suck. Be brave enough to suck at something new today. It's just really about starting somewhere. Can't change the whole world's problems overnight, but you can change one little thing at a time. I was telling someone earlier this week, I was like, there's this story about some bicycle racing team, and they were terrible. And their coach came in and said, we're just going to get incrementally better each day, 1% better each day. And over the course of the year, you don't get 365% bigger. You get like something like 1,000% bigger. And they eventually went on to win, Olympic gold medals and, it's a great story. But it is really a reminder that, you can just start somewhere and you can just get incrementally better at one thing each day. And over the next, 3, 6, or 12 months, that can make a huge difference.